Welcome to Talk Tickers. Today, we are breaking down the Crocs Q4 2025 earnings call. Let's dive right in.
Okay, let's just start with this number. When a stock rockets up over 19% in a single day after earnings, you know something big just happened. The market gave a massive thumbs up. And in this explainer, we're going to unpack exactly why. To really get this, you have to understand the mood before the call. The whole narrative was pretty cautious. Wall Street was basically worried about two big things: tariffs putting a squeeze on profits, and the ongoing weakness from their Heydude brand. But then the numbers dropped, and wow. Crocs didn't just beat expectations, they blew past them. Revenue came in more than $40 million ahead of schedule, which is great. But the real showstopper, the thing that made everyone sit up, the earnings. Adjusted earnings per share of $2.29 just shattered what analysts were expecting. I mean, that's a 20% beat. And that, right there, is what really got things moving. So what's so incredible is how this one quarter completely flipped the script. All those pre-call worries, let's tick them off. The fear about tariffs? Nope. Countered by really strong margin execution. The drag from Heydude? Well, management says that was an intentional cleanup. And pressure in the wholesale business? Yeah, it was there, but their own direct-to-consumer sales grew almost 5%. It felt like for every fear the market had, they had an answer. All right, so let's peel back the onion a little bit here. Because if you just look at the headline numbers, you're missing the real story. It's truly a tale of two very different brands with two very different strategies right now. So on one side, you have the classic Crocs brand, just chugging along, basically flat but stable. But then you look at Heydude and whoa, a nearly 17% drop in revenue. Now, management was very clear on this. They said, hey, this isn't a failure. We chose to do this. They call it a channel cleanup, which is basically just cleaning house, pulling back inventory from the wrong places to protect the brand's reputation for the long haul. It's a classic case of short-term pain for long-term gain. And check this out, because this is where it gets really interesting for the main Crocs brand. That flat growth we just saw, it's actually hiding a huge dynamic. While sales in North America were down about 7.5%, international was on fire, growing more than 14%. So that incredible overseas strength is literally carrying the entire brand right now. And that's a critical part of why investors are getting excited. Okay, so you've got this mixed picture, right? Heydude is taking a planned step back, and the Crocs brand is all about that international story. So what's the game plan? How do they pull this all together for 2026? Well, lucky for us, management laid out a very clear 4-part strategy. So here's the playbook. First, finish this Heydude reset. Get it done in the first half of the year, so the brand can start growing again in the back half. Second, protect the profits by cutting $100 million in costs. That's a huge number. Third, just lean into what's working. Keep pouring fuel on that international fire for the main Crocs brand. And fourth, keep putting your money where your mouth is by buying back a ton of stock, which shows serious confidence. And you really have to pay attention to this quote from the CFO. The key word here is executed. This isn't just some new promise they're making. They already finished a $50 million cost savings plan, and now they're rolling out another one that's twice as big. This commitment to efficiency is the secret sauce. It's how you can tell Wall Street that sales might be flat, but profits are still going to grow. And that brings us right back to the market's reaction. Because, yeah, the fourth quarter was great, but that wasn't the real reason for that 19% stock pop. No, the real catalyst wasn't about the past. It was all about the future. It was all about the guidance. And here's where the magic really happened for investors. Management guided to basically flat revenue for the entire year. You'd think that would be bad news, right? But then they dropped to the other shoe, their earnings guidance. That range of $12.88 to $13.35 per share was way above what analysts were expecting. It was a powerful signal that even in a transition year, they have the levers to pull to keep profits growing. And that is exactly what the market wanted to hear. And this was a real shift in sentiment because you can just look at the trading volume. It more than doubled on earnings day. This wasn't some low volume drift upwards. This was a high conviction move. This was the big money stepping in and saying, we believe in this plan. So when you put it all together, this report wasn't really about a sudden burst of growth. It was about management reestablishing its credibility. They made promises, and they kept them. With that in mind, here's our take on what comes next. If you're bullish on Crocs right now, the thesis is pretty clear. First, that $100 million cost plan gives them a real safety net for profits. Second, the whole Heydude mess is mostly in the rearview mirror, which removes a huge piece of uncertainty.
Third, the international business is still a growth machine. And finally, those aggressive stock buybacks help put a floor under the share price.
So, based on all of that, we're initiating with an outperform rating. Management has laid out a believable, executable plan for earnings growth, and they don't need sales to go to the moon to do it. The Heydude situation is de-risked, the core brand is a cash cow, and frankly, at this valuation, we think the market is underappreciating just how much control this company has over its own profitability.
This is not financial advice.